Hello everyone. Today we will be learning about options. What is an option? The term option basically means a choice to do something. In finance, the buyer of an option contract has the right but not the obligation to either buy or sell the underlying asset at an agreed upon price and date. To buy such a contract, the buyer of the option has to pay a premium or a fee to the seller of the option. Let us consider an example. A baker is worried about the increasing price of flour. In order to get the flour at a constant price, he enters into an option contract with his vendor to buy a sack of flour this month for $2,000. The baker pays a premium of $50 to the vendor. This amount is not an advance. The vendor gets to keep this amount irrespective of whether the transaction happens or not. If during the month, the baker observes that the price of the required flour is only $1,500, then he will buy it from the open market and not from his vendor. If he observes that the price of the flour has increased to $2,500, he will buy it from his vendor at the agreed upon price of $2,000. The baker thus has a choice. He can either buy the flour from his vendor or he can buy it from the open market depending on the price scenario. If the baker decides to buy it from the vendor has to sell it to him. Thus, the baker has a choice, but the vendor has an obligation. As this contract is an option to buy the underlying asset, it is called as a call option. Let us understand the terms associated with the call option. Long call is the person who buys the option to buy the underlying. It is the baker. Short call is the person who sold the option and promises to deliver the underlying if called for. It is the flour vendor. Strike price is the price at which the underlying will be bought. It is denoted using the letter X. Spot price is open market price that constantly fluctuates. It is denoted using the letter S. Premium is fee paid to the option seller. It is denoted using the letter P. Let us understand the payoff of the call option for both the long and the short. The long call will compare the spot market price with the exercise price and then decide whether to exercise his option or not. Example: if the spot market price is $2,500, the baker will decide to exercise the option as the flour is cheaper under the contract. His profit is $2,500 minus $2,000, which is equal to $500. But he has paid a premium of $50, and hence the net profit is $450. For the vendor, it is a loss of $450. As the option is exercised in this scenario, it is called as an in-the-money option. If the spot market price is $1,500, then the baker will not exercise the contract as the flour is cheaper in the open market. In this case, he will lose the $50 premium paid. The vendor has a gain of $50 as he gets to keep the premium. As the option is not exercised in this scenario, it is called as an out-of-the-money option. If the spot market price is $3,000, the option is exercised. Profit is $3,000 minus $2,000 minus $50, which is equal to $950, and loss for the vendor is $950. The option is ITM. If the spot market price is only $500, then the baker will let the option expire. He loses $50 and the vendor gains it. The option is OTM. If the spot market price is also $2,000, the baker can buy the flour from either of the places. However, in this situation, he is still facing a loss of $50. When the spot price is equal to the strike price, we call it an at-the-money or ATM option. If the spot market price is $2,050, the option is exercised, but the profit in this case will be 50 minus 50, that is 0. Thus, $2,050 is a break-even price. At this price, neither parties make any profit or loss. The option is ITM. The payoff diagram for the long call and the short call can be graphically represented as follows. The spot price of 2050 is the break-even price beyond which the long call starts making profits and the short call starts incurring losses. The long can earn unlimited profits, but his losses are limited to $50. That is the premium paid. For the short, the maximum profit he can earn is $50. That is the premium received, but his losses can be unlimited. Here is what we can conclude. When the spot price is greater than the strike price, the call option is exercised and the option is called an in-the-money call option. When the spot price is less than the strike price, the call option is not exercised and the option is out of the money call option. When the spot price is equal to the strike price, the option is at the money. For a long, the profit potential is unlimited and the loss is limited to the amount of premium paid. For a short call, the profit potential is limited to the amount of premium received and the loss potential is unlimited. The break-even price for a call option can be calculated as the sum of the strike price and the premium.